So when building your property business, you've got to realize that there are three different types of investors that you are going to want to work with. And all three investor types are different breeds of people. So you've got to approach them in a different way, and they are not going to be likely the same person if you want to build a longer term relationship with them. So what's really important to remember, the three types are the loan investor, i.e. the fixed return investor, the investor that's going to lend you some or all of the money for a percentage interest rate based on the amount of time that you need to borrow that money for. The second type of investor is going to be the joint venture partner. So that joint venture partner may well be that they come in on the deal, they are the financer of the deal, but then they share in the profits at the end of that deal. And then the third type of investor is just simply the investor that comes along who wants to buy the deal from you for a sourcing fee. Now, as you can imagine, the three different types of investor might have the same amount of capital, but their attitude to risk, their desired outcome, the length of time they may want to leave money in a deal, the type of involvement that they want to have is going to be very, very different. Now, in my opinion, the best type of investor is the one that wants to lend you money for a fixed return, because that's going to let you do the deals that you want to do. It means that you're not going to have to share that profit or that refinance figure at the end. You're just going to be able to pay back that investor on refinance with their interest rate that you promised. And it can be a very quick relationship. So of course you can borrow the money, do the deal, refinance it back out, or sell it and then pay that investor back with their interest. And then more likely, if you get the right investor, they're going to lend you that money again, maybe even lend you a little bit more. Now, of course, the joint venture partner is something slightly different, and that joint venture partner is going to likely want to be part of the limited company that you set up, the SPV, the special purpose vehicle. What that means is that they're going to share the profit of that deal at the end. So that may well be that there is no profit, there's nothing to share, and you've got nothing to lose, because of course that investor is effectively your business partner in that property transaction. Or they're going to get a heck of a lot more back for their money investment that they put in than they would have got on an interest rate, but they're also going to be very likely to want to be involved with that deal. They're going to want updates, they're going to want to know exactly what's happening, when it's happening. They may well even want site visits and everything like that. So they're a much more serious relationship, because you are now in a limited company with them. You're sharing the risk with someone else. So you're going to have to make sure that you really pay attention to who it is that you get into these relationships with. Do you trust them? Do they trust you? Are you confident that if things were to go wrong, they're going to still be on side, they're not going to turn difficult, and that you can manage that relationship? Because more often than not, it's when things go wrong that JVs go wrong, and the last thing you want to do is sort of be caught in a place where you're having an argument, you're having a fight with your joint venture partner over a deal, the profits, how it's sold, anything like that. Because something that you could have actually mitigated against at the start of the relationship. Then, of course, the third investor type is your investor that buys the deal from you. They just simply want to take that deal on themselves. They want to do the refurbishment themselves, unless you offer that service as an extra service. And they want to just simply pay you a fee for it. They get all of the profit at the end of the deal. You've got no involvement with the purchase or the exit, and it is very straightforward. You do lots of those on a monthly basis, and you can create a very generous, nice income. So remember, when you're speaking with investors, you want to make sure that you know what it is that you want to achieve from them, what you want to do with their money, how you want to have that relationship set up between you both, and then you're going to be in a great position to be able to know what it is you want, go out and get it, and do the deal the way that you want to do the deal.